Uh, all right, Nimesh, thanks for that. So we've spoken about IT and PSUs as sectors. I want to talk about one particular stock, and this is Bajaj Finance. And I'll tell you why this is interesting, right? I mean, Bajaj Finance is, if there is one name which is the absolute sort of top tier NBFCs, it is Bajaj Finance. Now, look at this headline, right? If things end like this, let's just go back to the first plate, please. If things end like this for Bajaj Finance, which is where the price is today, it will be the lowest return year, 2022, in the last 10 years. Bajaj Finance, as of today's close, is down about 8% for the year. Now, this is surprising, and this graphic will tell you why. The last time Bajaj Finance was down was in 2011. It was down 12%, and you can look at what has happened since. Just incredible run the stock has had, and this year, in 22, with a week to go, things can change, but I mean, I don't know how much. We're down 8% or so. So after 10 years, it's negative performance for Bajaj Finance. Now, this is what the stock has done, right? The lowest positive return for Bajaj Finance in that period has been 2013, which was 21%. The lowest return was 21%. Negative return years, of course, this year and 2011, as I said. And even with these two negative years, the CAGR since 2009 is 50%. I mean, this would rank in the top percentile. I think this would be number one or number two in terms of, if you just look at the Nifty 50 stocks from the 2009 Nifty index and look at the constituents, this would be right up there. Now, these are valuations and how valuations for Bajaj Finance have moved. And, you can see this step up, right? Every, 5 years, 6 years, the valuation moves up substantially and then it stays there. So in 2012, it was 1.8 times forward. This is all Bloomberg data. 2015, it moved up to 4 times. 1 year forward price to book. 2018, almost 7 times. It moved up to almost 8.5 times. This is, in 2021. And right now, it's come off a little bit back to the 2017-18 kind of levels at about 6.48. But this is standalone valuation. We'll have to put this into perspective. But in any case, the current valuation is still much higher than the 12-year average of 4.5 odd times 1 year forward. Let's compare this to something, right? Now, what do we compare this to? Let's compare this to what is widely considered the highest quality top-tier bank, which is HDFC Bank, right? Now, this is Bajaj Finance and HDFC Bank. We spoke with JP Morgan's banking analyst who said that Bajaj Finance, and the reason, if you compare the stock price of Bajaj Finance and look at their AUM growth, they're very closely related, closely correlated. The yellow one is Bajaj Finance, the yellow line is Bajaj Finance. As you can see, for a while, the loan growth was head and shoulders above HDFC Bank. There was a dip, during COVID period, and then it is picked up once again. This is F5. This is the last FY21 data. 22, there is data, but more importantly, look at FY24, which is what markets are focused on. Almost converging, right? HDFC Bank actually is at 26% estimated loan growth. Bajaj Finance is at 23 times. For 24, which is 1 year forward, HDFC Bank expected to do better than Bajaj Finance in terms of loan growth. Let's look at the other thing, which is profit after tax growth, PAT growth rate as well. Again, as you can see, Bajaj Finance head and shoulders above HDFC Bank for a while, right? This is the period of the valuation expansion. Sharp dip. HDFC Bank did not lose money during COVID. Bajaj Finance did report losses. And then there is a sharp recovery, which of course far exceeds what HDFC Bank has done. But here also, as you can see, there is some sort of a convergence. This is FY24 estimates. These are Goldman Sachs estimates. And FY24, Bajaj Finance is expected to grow profits of 19%, HDFC Bank of about 27% or so. So in both parameters, for 24 numbers, HDFC Bank still beating, which is a much larger entity, by the way, to grow at that rate and beating Bajaj Finance, quite something. Now, this is valuation comparison for both, and I think this is the point which JP Morgan's Saurabh was making. Bajaj Finance commanding premium valuations as compared to HDFC. At the peak, the number was about 172% premium over HDFC Bank's valuation. It's come off to 122 odd percent, but given the fact that valuations, and these are 1 year forward, given the fact that on both loan growth and profit after tax growth, HDFC Bank is still behind, Bajaj Finance is still behind HDFC Bank for FY24. you know, would you want to pay that kind of a premium? I think this is the kind of question which the market will pay attention to. I just want to leave you with what next, a couple of points. Bajaj Finance saw loan growth slowing during COVID. It's picked up as we just showed you. Rate hike impact is not going to be as big because of the absolute high net interest margins. We saw that in the second quarter numbers which Bajaj Finance reported. There is the digital aspect of it, right? The app is already live, but the management has said the full app rollout will be by March of 23. It's expected to show up in a big way in 24 numbers. And of course, on the flip side, there is intense competition. As compared to 5 or 10 years back, the amount of competition from lenders of all kinds, fintechs, etc., is much higher. So are we in for a more normalized 25, 30% growth rate for Bajaj Finance, or from the 40, 45, 50% growth that we've seen? Although I have to say, you know, whoever over a longer period of time has bet against Bajaj Finance's performance has proved to be wrong. So history and empirical evidence points to the fact that maybe 23 we will see at least a better performance as compared to what we've seen this year so far. Back to you guys.
Very interesting, Prashant. We need to get into a very short break, but we'll continue talking about the markets. We'll also invite Mihir Vora, CIO of Max Life Insurance.
Why did life test me? Why did it try to crush me, shake me, break me? Why me? Because it knew if I could take this test, I could take anything and say, that was easy.
Catch industry leaders in conversation as they discuss how the role of company secretaries has evolved many-fold in recent times and the impact of good corporate governance in a global economy. All this and more on ICSI Presents Company Secretaries, Enhancing Governance and Powering Corporates at These Times.
Presented by the Institute of Company Secretaries of India.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj at These Times on CNBC TV 18 and CNBCTV18.com.
Welcome back. You're watching Editors Roundtable. As promised, we've got Mihir Vora with us, CIO of Max Life Insurance. Mihir, great to see you. First, what happened this week, right? What explains this kind of sell-off that we had?
I think it's just one of those days where, or weeks where we are reacting, probably overreacting to global events. Okay. People are saying COVID and all those kind of reasons, but last couple of days China is actually up, where COVID is supposed to be spreading. So maybe a bit of year-end lack of buying from FIIs. Coupled with people squaring off their books, that's what it looks like.
So no reason for the markets to sell off from here on?
Well, if you see from the global perspective, I would, if I was a FII, if I was overweight India, then I actually done pretty well, you know. And towards the end of the, if I were a hedge fund, towards the end of the year, I'm going on a vacation on 24th. I probably want to square off my books and cut some overweight in India. That's what's probably happening. S&P is down 20% for the year in the US, while we are still flat. So there is some money, to be taken off as far as profit being is concerned.
Mir, are you getting a sense that the retail investors are now panicking? Because, this week's fall largely explains non-institutional activity picking up, and that's the reason for a sharper fall. I know, the SIP money is very sticky, the EPFO money is quite sticky, but the direct investment money which retail investors are putting in, are you getting a sense that that's now getting questioned and that's now getting withdrawn as well?
Maybe a bit of that, because if you see the sharpest fall has not even been in the mid-cap index.
Yeah.
It's been in the small-cap index. While the Nifty is, say, plus 2% this year, the small-cap index is minus 20. So a little bit of capitulation may be there in some of the counters. Also, it's kind of natural that in a rising interest rate scenario, the smaller companies tend to get hit more. Right. And that's probably one of the reasons why we've seen in the last 2-3 months small caps not performing, because cost of funds for them actually is very sensitive.
Right.
Actually, 2022 has been an extraordinary year, right? It's a very abnormal year because we took it because the market outperformed so much, ignoring what is happening to the rest of the world, and it happened over and over and over again. It never fell, right? It fell one, and then there was a sharp recovery.
Even more versus the other markets. Right?
Correct.
Absolutely.
So we took it to be normal. I mean, this is the way the market is always going to be. Maybe that kind of changes a little bit as we head into the next year, 23.
I mean, I wouldn't make that conclusion just on the basis of the fact that we've fallen from 18,800 to 17,900, because just 3 months ago we'd seen a similar kind of move. So these 6%, 7% moves are not to be taken too seriously.
We're not used to
It's
6% moves.
well, at the cost of being beaten up on this kind of a day, it's a healthy correction, I would say. But you never know, yeah.
IT bull or bear?
IT, I'm negative because I'm more.
But buy into the weakness?
No, I would rather buy into the domestic stocks which have fallen more. Some of the financials have fallen quite a lot in the last couple of months. So I'm more bullish on the domestic recovery thing.
So, exactly. Within financials, will you look at PSU banks after the fall?
PSU banks, again, for me, is more of a tactical play.
Okay.
If it's a 3 to 5 year buy and hold call, I would still stick to the private sector banks. But yes, those valuation gaps sometimes tend to get extreme. So when the private sector banking space, if it's done 100% and the PSU banks have gone up only by 20%, then you will see 20-40% move in that space too, just for the valuation part.
Bajaj Finance have presented some data that interests you.
Can't comment on specific stocks, but in general, I would still go for private sector banks versus NBFCs given the funding costs.
You know, the last time we spoke, you kind of sounded that you are exploring new age tech companies.
Yes.
Has anything changed? Have you bought anything?
I think in the last couple of months, things have become even more attractive and we are nibbling into the space.
You've started buying?
Yes.
Anything else, Mir, apart from financials, new age?
See, my hope and fervent wish is that industrials do well. Because unless the industrials investments, capex cycle picks up, we won't go to 7%, 7.5% GDP growth rate. That has to pick up, including real estate.
Right.
And valuations are still very attractive in this segment. So with a little bit of trigger, you can see huge outperformance in the capex, industrials, engineering, construction, those kind of things.
One last word, defense. I think that was a space you were interested in. You were optimistic, bullish. Stocks have doubled, right?
But it has corrected sharply now in the last 1 week.
Yes.
So the stocks are down 15-20%.
Yes, but that's, I think, a secular story which has just started in the last couple of years that can last for many years.
Right. So it's basically a buying opportunity
I would
at lower
think
levels.
so, yes, yes.
Thank you so much for dropping by, Mir.
Always
and
a
we
pleasure.
find that we hope that you find easier traffic on your way out than on the way in. Mir was supposed to be with us earlier at the start of the show.
But this seemed like a rapid fire, right, with him? But thank you very much,
Always
Ravi,
a pleasure.
for packing in a punch. And season's greetings to you,
You too.
your family, and everyone
Absolutely.
at Max Life
Have a
Insurance.
great 2023. Happy investing.
Happy. Well, with that, it's a wrap in this edition of Editors Roundtable. Hope you enjoyed it. Thank you once again.